Hello dear students, in this video we are going to see farm financial statement, that is balance sheet. Okay, myself Professor Vaishali Bharat Golab. This is one of the important topic of agriculture finance and insurance. In this video we are going to see how the balance sheet is prepared by the farmers to judge the financial position of the farm business. See, financial statements are prepared by the businessman at the end of the accounting year. Okay, this statement or this account shows the final result of the business carried out. Financial statement give a concise idea about the profitability, financial position of the business to management, owner and other interested parties of the business. There are three types of financial statement: income statement or profit and loss statement, balance sheet or net worth statement, and cash flow statement. In this video we are going to see in detail balance sheet, or it is also called as net worth statement. Okay, any farmer, whether small, medium or large, measures the financial performance of the farm business during an agriculture year or over the period of time. Balance sheet. The balance sheet, it is a statement of the financial position of a farm business at a particular time, showing its assets, liability and equity. Okay. Balance sheet indicates an account of total assets and total liability of the farm business, revealing the financial solvency of the farm business at a particular time. It shows the assets, liability and owner's equity. Okay, assets. What is mean by assets? What is mean by assets? Assets is which are owned by the farmers, that we call it as a assets. Assets are of three types: current, intermediate or working, long term or fixed asset. Okay, what is mean by current assets? Current assets, they are very liquid or short term assets. They can be converted into cash within a shorter time, usually 1 year. For example, cash on hand, agricultural produce ready for disposal, that is stock of paddy, black gram, jawar, wheat are the example of current assets. Now intermediate, or it is also called as working asset. Okay, intermediate or working asset. Intermediate assets are less liquid than the current assets. For example, machinery, equipment, livestock are the example of intermediate or working assets. Then long-term or fixed asset. Long-term or fixed asset, and assets that is permanent or will be used continuously for several years is called as long-term assets or fixed asset. It takes longer time to convert into the cash due to the verification of records, legal transactions. For example, land, farm building are the example of long-term or fixed asset. Clear? Asset. This is one of the most important, one of the components of balance sheet. Another component of balance sheet is liability. Liability means what? Liability which are OV to the others or by the farmers. Okay. What an entity own is assets, and what an entity OV is called as liability or obligations. That we call it as a liability. Again, liability are of three types: current liability, intermediate liability and long-term liability. Current liabilities are the debt that must be paid in the shorter term or in a year near future. Okay, for example, crop loan, account payable, hand loan are the example of current liability. Intermediate liabilities are those loans are due for the repayment within a period of 2 to 5 years. We call it as a intermediate liabilities. Okay, for example, livestock loan, machinery loan are the example of intermediate liability. Then long-term liability, long-term liabilities, the duration of loan repayment is 5 to 20 years, that we call it as a long term, or more than 20 years, that we call it as a long term liability. For example, tractor loan, orchard loan, then land development loan are the example of long term liability. Okay, then equity. Equity means what? Equity is nothing but, it is also known as owner's equity, is nothing but the difference between the assets and liability. These are the three important components of balance sheet. It is also called as net worth statement. This statement shows the financial soundness, financial position of the farm business. Assets, liability and owner's equity are the three important components of balance sheet. Now, balance sheet is represented in this form. Okay. Balance sheet is represented in this form. Assets and liability. You can see here assets. First of all, we are here write down the current assets. I have write down the current assets. Current assets are cash on hand, cash in bank, value of grain ready for disposal, livestock product that is egg or birds, fruits, vegetable fodder, feed ready for sale. Then value of bonds and shares to be realized in the same year are the current assets. And current liability are crop loan, account payable, hand loan, money owed to input supplier, annual installment of medium term and long term loan are the current liability. Okay. The typically balance sheet shows the assets on left hand side. You can see here typically balance sheet we shows the assets on the left hand side and liability and equity on the right hand side, and both the sides are always in balance. That's why name is balance sheet. Okay, these are the current assets and current liability. And then intermediate assets, dairy cattle, bullock, poultry, birds, machinery and equipment, tractor are the intermediate assets. Intermediate liability, livestock loan, machinery loan, unsecured loan. Then long-term assets, land, farm building. Long-term liabilities are tractor loan, orchard loan, unsecured loan. Okay. Then total of both the sides. Asset side total is 9,75,500, means current assets plus intermediate assets plus long-term assets. Total is 9,75,500. Then here total of liability is current liability plus intermediate liability plus long-term liability is 2,56,000. Then difference between total assets and total liability is nothing but net worth or equity. Means difference between 9,75,500 minus 2,56,000 is the total current liability, that will give the net worth or equity, that is 7,19,500. Okay. Now total of both the sides is total of the liability and equity is 9,75,500 and asset side is also 9,75,500. Both the sides are equal. That's why this statement is called as balance sheet. Okay. And balance sheet is prepared to study the performance of the business over a year by preparing the same number of balance sheet. If net worth increases over the different period, it indicates the efficient performance of the business. Now we are going to see some of the ratios which we are going to calculate from the balance sheet. Okay, first ratio is a current ratio. What is meant by current ratio? Current ratio is a total current assets divided by total current liability. Okay, I have calculate this ratio for this hypothetical balance sheet, hypothetical farm balance sheet. You can see here total current assets divided by total current liability. Total current assets are 1,26,500 and total current liability is 68,000. Then it will give the current ratio. That is current ratio is 1.86. This ratio indicates the capacity of the farmer to meet immediate financial obligations. Means this ratio indicates the liquidity position, short-term liquidity position. Okay, current ratio shows the short-term liquidity position of the business. And if current assets are more than the current liability but borrower fails to repay the loan, at that time that farmer we call it as a willful defaulter. Okay, current ratio reflects the liquidity within 1 year of year's time, and if this ratio is more than 1, it is indicate good sign, means farmers can able to repay the immediate financial obligations or short term loans in time. Okay, Current assets shows the short-term liquidity position of the farmers. Okay. Current assets reflect the liquidity within 1 year's time. Now second ratio is intermediate ratio. Okay. Intermediate ratio is total current and intermediate assets divided by total current and intermediate assets. Okay. This ratio indicates the liquidity position of the farm business over an intermediate period of time ranging from 2 to 5 years. Means this ratio shows the liquidity position for 2 to 5 years. Okay. Ratio more than 1 indicates the sound running of the farm business. And intermediate ratio reflects liquidity for 2 to 5 years. And if this ratio is more than 1, it indicates the favorable run of the farm business. Okay. This is a intermediate ratio. This figure we have calculated from the balance sheet. This hypothetical balance sheet. Okay, this is current assets plus intermediate assets. Total is current plus intermediate assets. Then intermediate liability and current liability, that is 68,000 plus 33,000. Okay, that ratio indicate the intermediate ratio. Okay, now net capital ratio. Net capital ratio, it indicates the solvency position of the farmers. Okay, long term solvency, because here we consider the total assets and total liability, right? This ratio indicates the solvency position of the farmer. If this ratio is more than 1, okay, if the net capital ratio is more than 1, the funds of the institutional agencies are in safe hand. Okay, there is no need to take the tension for the loan for such farmers. Okay, where the net capital ratio is more than 1. Okay, a consistently increasing ratio over the year reveal the sound financial growth of farm business, and farmer is a very prompt repair of all types of credit obligations. This is the net capital ratio. This ratio shows the solvency position of the farmer. Clear? Now, quick ratio. Quick ratio is a liquid assets divided by total current liability. Okay. Liquid assets means what? Liquid assets are those assets which are immediately converted into cash. Listen, liquid assets are those assets, those current assets which are immediately converted into cash. Okay, that we are called it as a liquid assets. Okay. Liquid assets, this ratio reflects the adequate of cash and income surpluses to cover all current liabilities during the period of 1 to 2 years. Okay, that we call it as a quick ratio. It is also known as acid test ratio. Quick ratio is also known as acid test ratio. And what are included in liquid assets? See, liquid assets include a cash receipt, account receivable, marketable securities, okay, available in more than 1 year are included in the liquid assets. Okay, and total current assets, that will give the current ratio or liquidity of the farm, immediate liquidity position of the farm business. Now, current liability ratio. Current liability ratio is current liability divided by owner's equity. This ratio shows the relationship between the liabilities and owner's equity. Okay, this ratio indicates the farmer's immediate financial obligations against the net worth. Net worth means difference between assets and liability. And a ratio of less than 1 indicates a healthy performance. This previous ratio should be more than 1, which indicates the favorable financial situation of the farmer. But the current liability ratio should be less than 1, that it indicates the sound financial position. Okay, that's why a ratio of less than 1 indicates a healthy performance of the farm business, and over the year the ratio should become smaller and smaller to reflect consistently good performance. This is a current liability ratio. Then debt equity ratio shows the relationship between the debt and equity. Here we consider the total debt. Okay, this represents the capacity of the farmers to meet the long term commitment. Okay, because here we consider the total debt of the farmer. The extent of indebtedness in the farm business is also shown with the help of debt equity ratio. The amount of capital raised by the farmer in running the farm business is also shown with the help of debt equity ratio, because total liability is the capital borrow from the outside, and this is the owner's equity, capital in hand of the farmer. Okay, that's why this ratio indicate the indebtedness in the farm business. The amount of capital raised by the farmer in running the farm business is also shown with the help of debt to equity ratio, and consistently falling ratio indicate a very heartening performance of the farming and ability of the farmers to reduce the dependency on borrowing. When it will less than 1, when the total debt are less than owner's equity, then it will indicate the heartening performance of the farmers and ability of the farmers to reduce the dependency on borrowing from the outside for the running the farm business. Okay, this is a debt equity ratio. Then equity value ratio. Equity value ratio shows the relationship between the owner's equity and value of assets. Okay. This ratio highlights the productivity gain by the farmers in relations to the assets he has. Okay. Productivity gain by the farmers in relations to the assets he has. The improvement in the ratio over the year shows the increasing strength in the financial structure of the farm business. Means then also this ratio shows the managerial ability of the farmers, okay, an essential element in raising the productivity of the assets. Okay, how effectively all the assets are utilized to increase the owner's equity or capital of the farmers. Okay, that's why this ratio indicate the productivity gain as well as managerial ability of managerial ability of the farmers to gain maximum returns from the investment or utilize all the farm assets effectively and efficiently. Okay, that is shown with the help of equity value ratio. These all are the ratios which we can calculate from the balance sheet. Thank you.